Good morning, this is Todd Hubbs, agricultural economist at the University of Illinois. Today I'm talking about my weekly outlook from February 11th, 2019. USDA reports provide little support for corn and soybeans. Last Friday, the USDA released the reports we've all been waiting on for about a month. We saw the expected production shortfall for both corn and soybeans that was sort of indicated between October and November with the yield. We saw a little bit of loss of acreage for both, but the use categories took some of the joy out of that yield loss. While we did see ending stocks for both come down, the use categories are sort of painting a bit of a bearish picture for both corn and soybeans as we move into 2019. So today I'm going to work through the numbers a little bit on both corn and soybeans. What you see in this slide is the USDA forecast from December, then the one they just released in February, and then what I'm sort of projecting for the 2018-19 marketing year for corn. As you can see, the yield fell from 178.9 to 176.4, a big loss. A lot of that, I think, through the harvest period, we saw some real issues with getting the corn out. So that brought total supply down to about 16.6 billion bushels. But really the problem for corn was found in the feed and residual and ethanol use numbers. USDA lowered feed and residual 125 million bushels. And when you look at the first quarter grain stocks reports and then back out what the feed and residual number is, it's reasonable that USDA lowered to 125. I think it's just overdone a little bit. We'll see as we move through the second quarter with the kind of livestock productions out there in the country. So I've got it at 5.41 where USDA has it as 5.375. We also saw in food, seed, and industrial use, USDA lowered at 40 million bushels. 15 million of that was from glucose, dextrose, and high fructose corn syrup use sort of waning in the first quarter, and 25 of that was ethanol. I've been sort of optimistic that we'd see ethanol grind recover a bit over the last couple of months, but with the really poor margins, the high supplies we've seen over the last year, and sort of the waning of use over the last couple of months, their number's not that bad. I've got it at 5.585 billion bushels now. There's 5.575. Now, if we do see an uptick in gas use, and with these lower gas prices, I don't see why that wouldn't be the case as we move into spring and summer. We could see some strength in ethanol, but what we've seen over the last couple of months has really lowered the use projections for 18-19. USDA's kept exports at 2.45 billion bushels. I'm fading them 25 million bushels at 2.425. We've seen this sort of weakness over the last few weeks. There's a lot of uncertainty in exports for both corn and soybeans. If there is some kind of trade deal, the ethanol and the exports are going to change completely, and it could even impact feed and residual. So that kind of uncertainty is just out there. But right now, I think we're going to hit about 2.425 billion bushels and put total consumption. I'm just a little bit above USDA at 14.885 billion bushels, but we're pretty close all around. I really have nothing to say about their numbers. They're understandable to me. My projections are just slightly different. We're looking at about 11.5 to 11.7% stocks to use with an average price in the 360 to 370 range this marketing year. That's how I see it right now. What you're seeing in this slide, the soybean balance sheet, as you can see from February, we lost a half a bushel per acre, and we lost some harvested acres as well, which brought total production to 4.544 billion bushels. That lowered supply about 61 million bushels to a little over 5 billion bushels. USDA raised crush 10 million bushels. I don't have a problem with that, but I was 10 million below them to begin with. We'll see as Argentina's crush comes online with this apparently big crop they're growing. We'll see what kind of competition we face in the second half of the marketing year. USDA lowered exports 25 million bushels. I've been trying to be optimistic on soybean exports for the first half of the marketing year. We've seen China come in for about 10 million metric tons. I was hopeful they might come in for a little more as these trade negotiations grind on. Right now I've got exports at 1.86 billion bushels. And honestly, folks, that could go a lot lower if we escalate this trade deal. There's a lot of downside in this right now, but there's also a lot of upside if we get some kind of resolution. Overall, we're looking at stocks, ending stocks around 910. I've got it at 935 because I'm slightly less optimistic on exports. Stocks to use around a little over 22%. I've got it near 23% with the seasonal average farm price at 850. And And we might have seen the highs earlier in this marketing year if this trade war escalates, which is not a good sign. Overall, not a lot is really strong information other than lower yields and a few acreage down for corn and soybeans from 2018, but the use levels are down across the board except for crush in soybeans. As we move forward into 2019, I see corn prices being relatively flat until we get the March prospective plantings report. Soybean prices could be in for a little bit of a tumble in the near term, and if the trade deal escalates in the long term. I think things to look out for right now: South American production in both corn and soybeans. Looks like the weather's moderated some in Brazil, so they may be able to put on a big corn crop along with Argentina and compete in the export marketplace. And what we're planning on planting. So that March prospective planting report is going to give us a good indication of the size of the crop in 2019-20. If we don't add a lot of corn acres, even with reduced use, we could see corn get pretty tight come the end of 2019. I'd like to thank you for your time. You can find my weekly outlook and daily analysis of issues related to Corn Belt farm economics at farm.daily.illinois.edu. I look forward to seeing you around the state of Illinois.